There are multiple ways to get your portfolio to grow, and in today's day and age, it often gets confusing in choosing what strategy to use. In today's video, we're going to be looking at 7 simple strategies to grow your portfolio. Let's take a look. It is often the hardest thing to gauge a dynamic market's movement. So much so that even the most seasoned investors and portfolio managers find it hard to predict the direction of where the market's headed. And there are a lot of factors to consider. Things like the market timing, risk tolerance, and then the principal amount that is being invested into the project. While there may be various ways to develop a portfolio, what cannot be denied is that there are pertinent risks in all of them. The difference factor, however, is how low the risk is, as opposed to how high the risk is, and how effective a strategy is in terms of improving and expanding the quality of your portfolio. So, let's take a look at 7 of the most effective, but rather simple strategies that would boom a standard portfolio, because these methods are foolproof, being tried and tested over the years. Make strategies that would work long-term, sustaining your investment. The first thing you need to do is get out of the scheme that you fooled yourself into believing, the get-rich-quick-and-easy scheme. This gets especially hard as the markets reach for bullish price, one that rallies against the odds. And it's easy to be lured into the prospect if we're honest. You practically have investors and market analysis popping out of everywhere, which say that your investments will be doubling in no time if you just have the confidence and the money to invest. Following their framework, of course, that they make guaranteed profit off of, whereas you don't. If you have a hint of common sense, you'll be quick to know that these are just gimmicks and tactics to con you, and you'll see through a Ponzi scheme like water. You should know that anything that's worth investing in, whether it be property that you're paying a mortgage for, saving up for your kids' college education, or even for your own education for that master's, you know it takes time to grow and nurture, so does your investment. For instance, a tip would be to never linearly measure time in relation to the principal amount you are investing. Look at it this way. By investing $10,000 per year in an index fund with a mean rate of return being around 8% or more, over 3 decades, you'll be able to gather up $1.3 million. That may not be a super fast method, but it does get you rich. Fine-tune the experts. If you've ever had an expert gloat and moan about a prediction shooting up or crashing down, simply neglect them. These people are nothing more than just crystal ball mystics who are good with PR. They think they know what they're talking about, but they really don't. No better than the average run-of-the-mill Joe. Basically, remember to stay clear of them, because they have the tendency to get your attention easily, with the most attractive feature of theirs being them speaking in hyperbole, one that tends to get your attention. And with the way they sell themselves, presenting themselves as these hotshot veteran analysts that are easy to believe. So take for their help. But if you're thinking of being in this for the long run, you will have to do things. Tune in on the circle itself. Be a part of the conversations that are happening around. Second, read up on the kind of investment strategies that might suit you and reorient your investment goals that would help you achieve the best results. It's okay to take help, of course, but it's better to help yourself. Diversification. This strategy is mostly combined with the buy and hold approach. A lot of risks are basically eliminated through this method. Numerous case studies have proven over time and time again that the method of asset location, which is pretty important when considering investment return, especially over extended periods of time. If you have the right combination of bonds, stocks, and cash, you can easily make the portfolio grow with much less risk involved and a lot less volatility than a portfolio that's been loaded with stocks. In a way, diversification has a contingency plan, because if one asset class is in the gutter, the other one would be stable. Overweight sectors. One way investors can increase their returns is to be overweight in a sector that looks shiny and lucrative. says Ron McCoy, president and CEO of Florida-based Freedom Capital Advisors. His firm has been dropping plays on the rollout of 5G mobile communications to portfolios that include names like Nokia, ticker NOK, and Telefon Ericsson, ERIC. There are many companies that will participate in the rollout of proper 5G, and one sector exchange-traded fund that recently launched is the Defiance Next Gen Connectivity ETF, FIVG. You can avoid single stock risk and participate in what appears to be a big change in technology in the next few years, he says. These can give your investments the credibility it needs. Some of the risks can be offset with longer holding periods and careful investment selection. Market timing. Another thing that you need to understand is that if you want your investment to flourish, you might want to check on the market timings. If you're planning on making a purchase, make sure to be smart about it. And the key to gauging market timing is buy when the prices are low and then sell when they're about to climax and fall short. This strategy is obviously more prone to getting you higher returns over the tactic of simply holding down an asset for a longer period of time. If you're good with it, that could even beat the buy and hold technology. For someone who's just not very seasoned or poised with this skill, it's better to just stick to the other plans that are sustainable in the long term. Market timing is a skill. Let us be very clear. Rebalance regularly. This method revolves around getting your portfolio to its original degree of diversification. For instance, if you distributed 60% of your portfolio in stocks, 30% in bonds, and 10% in cash, then you'll have to be vigilant to rebalance your stocks if your stock allocation has grown higher than 60%. The same could be said about a bear market that's on the rise. Whereas, if your stock allocation has fallen to 40% or less due to the crashing market, you should be ready to rebalance to increase that position. This can be a really sweet advantage for you to gain when the market actually comes towards recovery. But we are really vigilant of the fact that bear markets are something that don't really last. The August mini crash should be a reminder of that to anyone who has been casually disregarding the process of diversification over the past few decades. Markets are prone to fall much more quickly than they are prone to rising, which means that preparing in advance and having a plan B is very necessary. And that is what asset diversification is all about, adjusting to circumstances that change. No matter how good your stock allocation is going, be sure to assess and keep an appropriate percentage profile of your portfolio in both fixed income investment and the cash flow that comes. Find low-cost ways to upgrade and refurbish your investment. It is pretty easy to ignore investment expenses during a market's bull run, especially if you're making good money. However, the financial impact of that can only be so well balanced, and that would be pretty dangerous. In fact, even just lowering your expenses by a minimum of 2% for the sake of your investment portfolio's longevity. For instance, you're earning an average of 10% per year on your portfolio, but paying 2% in investment fees of all types. That will leave you with a net rate of return of 8%. If your portfolio is $100,000, it will grow to $466,097 after 20 years. If you can cut your annual investment expense to around half of that, to just 1%, your effective net return will rise to a whopping 9%. If your portfolio is $100,000 after 20 years, it will grow to $560,440. That's a difference of about $94,000, nearly $100K. And you could save potentially $100K by reserving just 1% of your expenses. In order to look for the lowest fees you can, look for an online broker that has either a low or no annual fee and transaction costs that are low. Another tip is to prefer funds over individual securities, and since you won't trade them as regularly, choose no-load funds wherever you can. You'll have to adopt a long-term perspective and maintain the discipline to work on your investment plan year by year, and to not allow yourself to get sidetracked by various Ponzi schemes that look like they're dripping gold. If you are already doing that, then you are going to be good too. But you might have to use some of the strategies mentioned above to foolproof your investment agenda. That's all for today, folks. See you in the next video. Ciao.